So, an IFA is an investment strategy which allows a financially successful individual or their corporation to use excess cash flow to acquire life insurance. And it is more effective from a cost perspective than tying up available cash resources inside their organization. Using deductions that they can take advantage of and leverage, so borrowing upfront to replace the cash value used to pay the premiums, gives the individual or the corporation the ability to continue to build wealth. Additionally, life insurance policies purchased obviously gives the individual the protection they need or the business should something happen to them. It gives family members the resources they need to cover any immediate tax liabilities, and it also gives the money an injection of cash should they need to look for a key replacement, a key employee, in order to continue to give the business, I guess, the direction that it wants to go in. So the slide here very simply says it is a sophisticated financial planning concept. It can be complicated. It's not necessarily complicated all the time, but it certainly can be. And a lot of it comes down to understanding when an IFA works and when an IFA does not work. So the client profile, typically what we are looking for is an individual that needs life insurance protection. Okay. The IFA, in my opinion, is a secondary sale. This is an insurance-based product, so the insurance protection is most. You're talking to individuals that might be concerned about the opportunity cost of the insurance premium. So, as I mentioned in the introduction, we're looking at somebody that has available cash sitting inside their corporation that could be earmarked for other business ventures. And as much as they see the value in the insurance, they don't want to tie up the money, or they don't want to have that opportunity cost of tying up the money when they can be using it for other sources. Primarily affluent and financial stable individuals or financially stable businesses. We're looking at individuals that could be subject to potentially some of the highest marginal tax rates because there are some deductions that would benefit those individuals long term. We do need a source of steady cash flow. So oftentimes when we're talking to high net worth individuals or incorporated business owners about the IFA, the reason we look for steady cash flow is because even though these structures typically show a reduced payment period, we still need the individual to have the money on hand to be able to pay the premiums on an ongoing basis. Certainly, we're looking at somebody that is risk tolerant and comfortable with that. So oftentimes what we would see is, real estate investors, developers, somebody that has been borrowing money before and is comfortable sustaining a significant level of debt. Typically, individuals are in the established phase of the business. It can certainly be individually owned or corporately owned, but you're usually looking at individuals that are slightly on the the higher end of the spectrum when it comes to age. So 40 to 55. We've even seen some IFAs done in 60 and 65-year-old individuals as well. Okay, so some of the benefits of an IFA, and I'll cover some of these as well as I give you some of the speaking notes when we take a look at how it works. So obviously, the life insurance that the individual is buying is going to provide an immediate increase to the overall estate. They do have access to cash for other investment purposes, and again, this is kind of tackling that objection about the opportunity cost. Um, it also gives clients the ability, or I guess the opportunity, not to choose between the insurance and the investment. So for somebody that sees the value in the life insurance component, they don't have to choose whether to leave the money inside the corporation to invest it or to do the insurance solution because you can benefit from both. Obviously, cash flow for the insurance is minimized because the only out-of-pocket cost to the client would be the cost of covering the interest charges on the loan, which we can talk about in a few minutes. There are some multiple tax advantages that the individuals can obviously take advantage of. And essentially, they are creating an increase in the overall estate or an increase in wealth because they have now two assets that would grow, the life insurance policy and any other business venture that they chose to go into. So, how does an IFA work? Here's a very simple graphical interpretation that we use when we're speaking to clients. First and foremost, an individual or their corporation acquires the life insurance policy. Okay. The owner of the policy, whether it's an individual or a corporation, would pay the initial premium, which is important. The policy then is pledged as a collateral to secure a loan or a line of credit from a financial institution, such as a bank, trust companies, or credit union. The primary lending facilities that we work with are Manulife Bank, TD Bank, Scotia Bank, and every now and then I have seen a client that goes to RBC or BMO, but unless it's a partner that works with Equitable Life, the client at that point would be responsible to explain the concept and negotiate the lending agreement. The owner of the policy, once the policy is pledged, borrows an amount equivalent to the premium paid to replenish the initial cash outlay. Now, keeping in mind that the loan is going to be tied to the cash surrender value of the policy, additional collateral may be required by the financial institution to secure the loan if the cash value of the policy is not sufficient to repay it. So by replacing the cash used to pay the life insurance premium with a collateral loan, the initial out-of-pocket cost to the client is only the interest associated with acquiring that loan. So you can see how it would be beneficial for them to borrow money back and then buy insurance as well, only being out of pocket what the interest cost would be. Upon receipt of the collateral loan proceeds, so whether it's line of credit or a lump sum loan, the cash at that point can be redeployed into other income producing activities. As I mentioned before, in essence, the same dollars here are invested twice, once in the life insurance policy and the other in an income producing property or activities, thereby allowing continued growth in the value of the corporation and, of course, allowing for growth in the life insurance policy as well. So, really giving the client the benefit of, you know, um, growing two assets using the same pot of money. What happens when the individual passes away? Well, at death, the outstanding collateral loan balance would be repaid using the death benefit proceeds from the life insurance policy. Any excess proceeds at that point are paid to the beneficiaries. So when a policy is owned individually, the death benefit could be received tax-free as long as we have a named beneficiary. Where the policy is owned inside the corporation, which is most of the setup, setup structures, I guess, that I have seen, the beneficiary would normally be the corporation, which would facilitate access to payment of the tax-free death benefits through the capital dividend account credit. So the proceeds would go into the corporation. The corporation would then, at that point, satisfy the loan repayment, and the death benefit proceeds that are remaining would be subject to the capital dividend account and tax-free transfer to the beneficiaries. Okay. So before the disclaimer, what are some of the advantages of the IFA? So a lot of this is done again on the premise of buying life insurance first and foremost, but there are some tax advantages in being able to to put the structure in place. So the proper structuring of an IFA and the use of borrowed funds under the collateral loan arrangement can provide some additional deductibility in the form of interest. So the interest can't be deductible, but in order for the interest to be deductible, the amount has to be paid in the year or payable in the year in respect to the loan. The amount of the interest deduction is going to be based on a percentage of the total outstanding loan. And if you're using that money to invest to earn an income, then the interest can be deducted. from a tax perspective. One of the other deductions that an individual can benefit from when they are working with the IFA strategy is the deductibility of the NCPI. So it's not the premiums. Oftentimes we get asked if the premiums are deductible for life insurance purposes. Generally, the premiums paid under a life insurance policy are considered to be on account of capital and therefore are not deductible. However, the NCPI could be deducted as long as the insurance is required by a lending institution to satisfy a loan. Where that criteria is met, then the deduction for the NCPI works as follows. You can deduct an amount equal to the lesser of the premiums payable under the policy for the year, the net cost of pure insurance in respect of the year as determined within the prescribed rules, or the least of the two amounts. So to kind of put that simply, and I guess in layman's terms, the NCPI represents a notional cost of insurance based on the prescribed assumptions that the insurance company is using. So it's obviously based on mortality rates provided by, and also within the tax regulations. So when we are looking at the premium deduction, what ends up happening is we have a premium deposit, but then we have NCPI that increases on an annual basis. And we're going to see that in the illustration that we're going to look at in a few minutes. So inevitably, in the earlier years, the net cost of pure insurance is going to be lower than the actual premium paid. So the deduction for the IFA in the earlier years could be substantially lower than the client anticipated it was going to be, but there are, again, the deductions that are taken into consideration. So a very simple example, if we have a $100,000 policy and we're going to borrow back $100,000, and if the interest rate on that $100,000 is 5%, the client would be responsible only for paying, in that specific scenario, the 5% interest, so $5,000, okay? But we have the deduction of the interest that we can take into consideration and the deduction of the NCPI. Depending on what those amounts equal, the $5,000 out of pocket could end up reducing to being maybe a $4,000 out of pocket. And the illustration we're going to look at will give us a better understanding of the numbers when we start to go through the IFA. Okay, it's important though to understand that the use of the collateral loan strategy, specifically when it comes to the IFA, although it does create some opportunities for enhancing growth, it also does, I guess, enhance the possibility for increased financial losses, because depending on where the client is going to invest the money, they're going to be subject to some market volatility, whether it's in real estate or whether it's in passive investments, although we typically don't suggest that. They're going to be subject to some volatility from that perspective. So one of the things that we always recommend, also keeping in mind that policy owner dividends are not guaranteed and also subject to change, is that an investor considering an IFA should always have sufficient access to other capital to cover the interest costs associated with the collateral loan and to pay any tax liabilities should the life insurance policy need to be surrendered to repay the collateral loan. Oftentimes I get asked, what happens if my client no longer wants to continue with this kind of strategy? Well, if the client no longer wants to continue servicing the loan, then one of the options is that the client has to pay the loan. And if they don't have enough money on hand to pay the loan, the only way for them to do so is to surrender the policy. And if the policy's cash value is over and above the adjusted cost basis of the policy, then that is also going to generate tax liability, because that is going to be classified as an income inclusion that the client has to pay taxes on. So maybe they won't have enough money to repay the loan. So as an exit strategy, one of the recommendations is to always make sure that if you're positioning an IFA strategy, that the client is going to have additional money to repay the loan should they need to at that point in time. Okay, so before we get to any questions and before we get to the illustration, I'll summarize by saying this. So IFAs, in my opinion, are truly a secondary sale. Typically, clients considering this strategy have a need or desire to own permanent life insurance. They run a business, such as a manufacturing business, some retail, maybe some real estate developers, or they could be involved directly in investing in things such as second mortgages, like builder financing type of arrangements, stocks, etc. In short, the yield that they receive on their business ventures typically far outweigh over the long term, what they would achieve in saving their cash inside in insurance. But they need insurance. So what we are suggesting for them is to put the money in the policy, borrow it back, and then redeploy it to those other resources. Think of it like selling an estate bond or an estate transfer, very similar to a buy-sell agreement or any other kind of life insurance need. Only the difference here is you're financing it versus tying up your own capital inside the policy. And the only cost typically associated with the arrangement is the carrying cost of the interest. So, a couple of things that you need to understand before even positioning an IFA or even discussing a case with me or a tax and estate planning consultant is we really need to understand the insurance being sought. So, what is the purpose of the insurance? What is it meant to do? Is it estate creation? Is it estate conservation? Are we looking at buy sell, key man protection? Are we looking to pay off some capital gain tax liabilities at death? Okay. That's first and foremost one of the most important points to discover. We also need to quantify the need from an underwriting perspective. So just being able to deposit $100 to $250,000 into something like this doesn't really apply, because you still need to position the life insurance benefit to the underwriter. So if it is a state creation or an income replacement type of strategy, explain to us how you determine the amount. Okay. If it's a state conservation type of strategy, then you need to explain the projected tax liability and how that was determined for the client. And usually you do that in conjunction with an accountant that might be able to help. From a buy sell perspective, you need to be able to provide the valuation from the accountant, or from the business owners if they have it. From a key man perspective, we need to provide the earnings and the rationale for the amount requested on the individual. And if it's an insurance amount to cover the loans, then we need to understand what those loans are, because we need to make sure that the insurance provided after you take an IFA loan is going to be substantial enough to satisfy any of those loans in addition to the IFA loan. If it's in combination, so if you're looking at a strategy that's going to cover all of these, the recommendation is usually to include a cover letter, which will help you explain to the underwriter the reason why you're applying for the amount of insurance that you're applying for. See, the challenge with these type of strategies when they're positioned in an underwriting perspective, sometimes it's not the financials. Sometimes it's the way that you position it to the underwriter who doesn't fully understand why it was sold in the way that it was sold. From a financial perspective, whether it's corporate or personal, we usually request 2 years of financials. If it's a business, we want to see profits and losses, a balance sheet, income and expense statement, an explanation of the earnings. And if the company is affiliated or associated with another company, then it's important that we understand the flow of money from one to the other, especially when the insurance is going to be held, let's say, in a holding company, for example, when we know the operating company is the primary revenue generating machine. Okay. A couple of other things that we need to consider, and this is more from the lending side of things, is we need knowledge of assets for additional collateral. So as I mentioned before, the loan provided by the financial institution is tied to the cash surrender value of the policy. So in the earlier years, it could very well be that the cash value of the policy does not equal the premium that you are putting in. In those type of situations, the clients then need to pledge some additional collateral to be able to borrow back 100% of the premium. Okay. And I can't stress enough the cover letter to the underwriter and At the same time, that cover letter could be provided to the lender as well. And you can explain the reason why you're applying for the insurance, and you can explain to the lender the reason you require that amount of money. So before we look at the illustration, are there any questions with everything that I have just covered?